please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, the story of the moment, the story of the week, of the month has been the turmoil in emerging markets. It's taken its toll on currencies and on equities. Is there a respite in sight or is there more turmoil? Adrian Mowat, emerging market equities strategist, joins in with his thoughts. Good morning, Adrian. Always good to have you with us. Your assessment of the kind of currency bashing you have seen. It's also spread to relatively quieter areas like Filipino peso. I think they're in for their 4th rate hike, and the Indonesian rupiah. Is there more turmoil awaiting emerging market equities as well?
I think there is for now. The factors that are driving EMFX weakness. So if we look at the broader sort of JP Morgan EMFX index, it's down about 15% year to date. So India in that perspective is a modest outperformer. The best relative currency versus the US dollar would be the renminbi, which is obviously quite well managed, but it's been relatively weak versus its trading range. Now, the extremes that we've got here have been coming through from Turkey plus the Latin American countries. And as we look at that situation, there's nothing being resolved as of yet. Politics in Brazil and Mexico still looks pretty challenging. The Argentines are hoping that the IMF will come in quicker. So I think this environment of weak EMFX is to stay for now. I think with the Indian rupee, moving through 71, it's important not to specifically look at the rupee, but to look at it in a broader context of what's going on with EMFX. I note you are highlighting that the central bank has come in modestly. I think what investors would like to see from the central bank is maybe managing a bit of volatility. But I don't think investors actually would welcome the central bank sort of drawing a line. I don't think that's the appropriate thing to do. The way these EMFX crisis comes to an end is you get an overshoot in currencies. And one of the reasons why investors start to put capital back into the countries is because they view the currency to be undervalued as well as the market.
Okay. Sure, that point is taken, Adrian. Good morning. But do you think the equity market has priced this risk in adequately? We've corrected a bit from the top, but for Indian market, we're still very close to all-time highs. And we've started to see some of the expensive stocks correct over the last 1 week or so.
Yes, so I think let's look at the fundamentals here. We've got a weak currency and a relatively firm oil price. As I look at the consensus forecasts for CPI for next year, they're sitting at 4.8. That feels a little bit too low. When you start to look at the consensus on the RBI raising rates, the types of moves seem very modest, 25 basis points. I mean, I note that Uday Kotak came out today and was talking about a 50 basis point move. And that's is important for the broader capital market. Year to date, what we've seen in Indian equities is this big dispersion of return. Generally, domestic cyclicals have done poorly. Exporters have done very well, particularly the IT names, which is logical considering what was happening with the currency. And then some of the more defensive plays, like FMCG, have been good year-to-date performers. So as I think about risks for 2019 calendar year, it's quite possible that inflation is going to be higher, that the consumer's discretionary income will therefore be under pressure. If inflation is higher, then we need to think about higher interest rates, and those higher discount rates are going to be important for expensive stocks. So the short answer, which I should have given you at the beginning, is I don't think the market is pricing in this inflation interest rate risk based upon local equity prices.
Okay. Adrian, hi, good morning. So what do you do with a market like India now? Do you stay away entirely? Do you book profits and move into, say, other markets? Where would India feature in your pecking order?
Yes, so I would be tempted to be booking some profits in the Indian market, particularly in the IT names. You know, and some of these, as you screen within the Nifty, are up more than 40% year to date. I think that's where you should take some money out of the market. I don't necessarily feel that you should be aggressive in reallocating that to other markets at this point in time. You know, we seem to have this dynamic in EM where we start to get the pressure points, the corrections coming out of the more vulnerable markets, where you see more dramatic currency moves. And then you get a bit of a rolling correction in EM. You know, we do have an environment where passive products are very large. Generally, passive products are enjoying large inflows as EM equities did well last year through into January this year. And now that's where you're beginning to see the redemption pressure. And India is going to be subject to that. And it doesn't feel like an environment where you're going to attract new capital to these markets until we get a little bit more stability.
Okay. Well, Adrian, there is another probably secular trend playing out of Indians investing more in financial instruments. Of course, perhaps the movement from gold and land would have come anyway because the prices of both these assets have fallen. But probably because of demonetization and GST, there has been a greater financialization of savings. And that's kept the market higher, although foreign investors have not been investors. In fact, they've taken out money from Indian equities. Does that therefore justify a higher valuation for India simply because of the march of domestic savings?
Well, maybe the way to phrase it is it doesn't justify a higher valuation. Okay. It may result in a higher valuation because you do have, you know, a large positive household savings rate in India. And if that capital is moving from other assets into equities, then that will support valuations. I think if you wanted to pick on a country as a good analogy here, it would be Australia, where valuations have moved higher because of the success of the superannuation fund. So it doesn't justify them, but it may result in these higher valuations.
Fair point.
Okay, what about, you said you're tempted to book profits, or you would book profits in the technology names. Any other spaces where you would move out of? I mean, everyone seems to be a bit circumspect about consumption now because of the way valuations have moved. Your thoughts?
Yes, so you know, I was highlighting earlier a concern that as inflation moves higher, then discretionary income gets put under pressure. So the growth rates for FMCG companies could weaken going into calendar year 2019. So you know, you've got a levers is upward 18% year to date. I think that's another area for investors to trim. Take a little bit of money out of the markets for now, and a bit of a wait and see, I think, is the correct approach here. You know, you're not forced to always be in markets. India, for the domestic investor, has had some very attractive returns in large cap stocks. Take some money off the table for now. I think you will get you know, Indian equity markets drawn lower because of the issues elsewhere in EM, and perhaps you can then reallocate that capital at a slightly lower share price.
Okay, Adrian, towards the end of the year, we will be having 3 big state elections. Next year, of course, general elections. In the past, we've seen, you know, tactically that's been a very good time to play the market, even if, you know, post the elections, that trade reverses. From your point of view, you know, what's the best way to approach the election season?
Do you know, I think it's, you know, the analysis that we've done in the past, it's quite difficult to generalize about the impact of elections on the Indian equity market. And remember that we've had some shocks out there. There was much enthusiasm with the BJP and Indian shining, and then we had a shock result coming through. I think what we've seen so far in the market is generally an assumption that it's going to be a better environment for the rural consumer, and people have been playing the rural consumer theme, but that's probably come through in the share prices already. So I'm struggling to have a powerful strategy built upon an election cycle. There is a chance that the opposition parties put up a bit more of a united front and become a bit more of a challenge for the government. And I'm not really sure if the international investors have really been factoring that in.
Okay. Well, yes, election forecasts are way more difficult than stock market forecasts. I take your point on that. And at the moment, it does look like the ruling party's chances have dwindled a bit, though the opposition getting an outside chance is still debatable. Thank you very much, Adrian Mowat, for speaking with us and giving us this EM perspective. It was a pleasure listening to you, as always. Well, that's the scenario we are in terms of EM markets where rates have risen. So that means the discounting rate for equities also, the cost of capital argument, will work against equities, especially where valuations are high. That's the key takeaway. With that, on to technicals.
Oh, yes, let's do that. In fact, Ashwini Gujral and Mitesh Thakkar back with us. Rajat Bose is also here. Ashwini, we discussed the index setup. In fact, as we speak, now we are at the high point of the day. Thoughts here, and of course, what are your stock calls now?
See, financials have moved up strongly. So my sense is that possibly low of the day could have been made, and it's probably the expiry trade, etc. So today's early morning decline failed to take yesterday's low out. So that means there could be some upside going into today's expiry. So what you need to do, what we have done is we've gotten long on Bank Nifty and have also loaded up on PSU banks. So Canara Bank is a buy with a stop of 268, target of 282. PNB is a buy with a stop of 82, target of 88. And Kotak Mahindra is a buy with a stop of 1240, target of 1275. Now whether this is a real thing, pullback, that time will tell, but for the moment, I think day's low is in, and we should move up at least towards 27,800 on Bank Nifty, and maybe even 11,550, 570 on the Nifty.
Okay, so there's a buy on Canara Bank, there's a buy on Punjab National Bank, and there's a buy on Kotak Mahindra Bank. So 3 banking stocks is what we have at this point in time from Ashwini.
All right, let's re-invite Mitesh Thakkar into the conversation. Good morning again, Mitesh. What are you trading?
So I have one buy and one sell. As I mentioned in the morning, I think Tata Alexa still remains a sell for me. I'll sell it if it breaks 1352, 1353. Keep a stop at about levels of 1371 and 1320 should be your first target. And Bharat Forge seems to have opened with a gap up. Looks like a continuation movement. That's a buy with a stop at 664 for targets of 708.
Okay, by the way, let's just pull out the Adani Enterprises now, because now that's listed X of gas business. I think we were waiting for that.
60 rupees lower, I think, is where it 66 rupees lower now is where it listed X of the gas business.
Yes, so
I think it's worse than expected.
Worse than expected, yes, definitely. So that's why it was, just wanted to look at that.
I think the range was a 40 to 50 rupees cut. That's what Anisha tells us, and it's come with a 65 rupee cut in the initial tick, so 30% lower there, X of the gas business. But we have the pharma names which are doing very well once again this morning. Aurobindo Pharma is up 4.5% right now. Glenmark Pharma continues to hit 52-week highs. Rajat Bose is also with us. Rajat, hi, good morning. What stocks would you be trading today?
I'll trade one real estate stock and one pharma stock. Pharma stock is Okhard. I'm expecting it to scale up to 671, 672 kind of levels and put a stop loss below 653. And the real estate stock, some shares of which I hold personally in my investment portfolio, it is DLF. Put a stop below 203.45 and targets would be 210 and 212.
Okay. Gentlemen, thank you very much for joining us with your thoughts today and your 10 a.m. trades. At the moment, the markets have held on to the green, and the Nifty and the Bank Nifty are up a little over 0.25%. The rupee is holding after maybe the RBI's supply, but people are still trying to test. 71.87 is not a big shout from 72 or from 71.93, where apparently the intervention has taken place. So, you know, you really need to watch out like a hawk if you are a trader. 71.88 as we speak. A very good time as any to invite Manisha Gupta to tell us all that's happening in the commodity space as the market opens there. Good morning again, Manisha.
Thank you so much for that, Lata. Well, it's quite a mixed trade that we have seen in for the crude oil prices. On the lower side of the range, really, because for the second straight day, we have seen some profit-taking come in here. But it really is divided when it comes to fundamentals. On one side, it is the EM growth concerns that the markets are tackling with. But on the other side, the US dollar seems to have taken a bit of a pause. And then there is an OPEC report, which also says that for the first time, the world is readying itself for a breach of 100 million barrels per day of a demand breach number. So that is where you are seeing some support come in as well. So even as we did see 0.25% of a decline on the opening trades, we are trading quite flat in the Asian markets right now. And that is where the Indian markets take a cue from as well. Very flat, just 1/10% of a gain is what you can see on your screens for crude. The pause in US dollar has been supportive for the precious metal space as well. So we are off the kind of lows that we were trading in yesterday. The silver prices for sure is off its 32-month lows in the global markets. Remember, yesterday we hit a 14-month lows in the Indian markets as well for silver, but some bit of a bargain buying coming in on your screens and nearly 0.5% of gain for both of those metals as well. That's exactly the picture that you would see for the base metal prices also, where we have seen some bargain buying come in. The US dollar taking a pause has definitely been a supportive, but of course there are concerns from the trade war that is going on in the global markets. It's a deadline tomorrow, and you might see US actually putting tariff on $200 billion worth of Chinese goods as soon as tomorrow, and that is what would really worry that market. But at this point in time, it's good buying that we have seen in Shanghai and LME markets. More than a percentage point up for some of those metals is the kind of buying that we have seen, and you can see that being mirrored in the Indian markets as well.
Your trading strategies?
Yes, I was coming to that.
Okay, sorry.
We have them from Grow Value, which has a buy in case of copper. They are watching out for targets of 433 on the higher side, but they do not believe that you would see sustained gains in the lead prices. So a sell call there, 144, 142 is what you can see on the lower side.
Okay, thank you very much for that, Manisha. We'll touch base with you on the hour. And just to remind everybody, don't take your eye off the rupee. It's still getting challenged after maybe central bank intervention. Still at 90 already, 71, 90, 93 was the intervention point, looks like, or at least the point at which the U-turn happened. But look so quickly, probably in a matter of 15 minutes, it's once again nudging 71.90. Yeah. Don't take your eyes off. That's a very decisive factor for bonds and for equities. Bond markets as well have not really climbed any higher. Bond prices have not climbed higher, and yields have not climbed lower, still at 807. We take a break on that note, and more market talk is lined up with another market watcher and expert, Sandeep Bhatia, Head of Equity in India of Macquarie Capital Securities.